Hi there, welcome to a Kneppy Invest and welcome to another technical update video because it is a Sunday, the 20th of April 2025. Current time in southeast Queensland or Brisbane is 11:05 a.m. on a pretty nice, beautiful Brisbane morning. I did take the dogs out for a 2-hour walk this morning and then we came home, I fed them, and then I went for a run. I probably would prefer the humidity to be a little bit lower. So I'm talking about dew points. I would prefer the dew points to be a little bit lower, but we should see the dew points starting to lower over the next few months because we are heading into one of the best times of the year to be in this part of the world. No complaints from me. I don't mind those cool to cold mornings that we do get, but usually if we do have those mornings, that means it's going to be clear and usually it warms up really nicely. I definitely prefer Brisbane than, say, Melbourne this time of year, particularly into the winter months. And there's a reason behind that. And I do know quite a few people who I work with who have lived their whole lives in Melbourne. They come up to Brisbane and can't believe what it's like in this part of the world during the winter months because it can be absolutely stunning. Okay, this is not a sales pitch on living in Brisbane. This is a video on looking at charts, lots and lots of charts. Okay, so the agenda for today's video will go through indices, commodities, crypto, bonds, currency. And what I'm going to do is I'm going to focus on the weekly chart because it makes sense. I do this video every single week, so focusing on weekly charts is probably the way to go. And what I've also done is I've included just the 200-week moving average. And this is sort of a homage to Charlie Munger, who stated, now it is alleged that he has stated, that if you bought high-quality companies at the 200-week moving average, you will do significantly better than the overall market. Now, I actually did ask ChatGPT where Charlie Munger said that, and ChatGPT came back to me and said, well, we can't find it, but it is a saying that has been attributed to him, and I think there is a possibility that someone just made it up and said Charlie Munger said it, and then someone picked up on that. And of course, Chinese whispers goes around. Someone hears it from someone else. Yeah, Charlie Munger said that. And I think there is a chance he never said it because it doesn't really make sense that he would say it because he's not much of a technical analysis person. So you do see that saying a lot. In fact, there is this particular article from NASDAQ. Charlie Munger strategy, buy quality stocks at 200-week moving average. And I just wanted to see where he said it, and I just can't find it. And ChatGPT said, he didn't say it. Or we can't find evidence that he said it. Anyway, so that's interesting in itself. But it's a really good strategy. And I think this strategy would work for most investors. So I thought, can we apply that to indices? Can we apply that to indices? So that is what I'm going to do in today's video. Not only will I do that with indices, I'll do that with commodities as well, and crypto and bonds and currency. But when we get to the individual company part of the video, what I'm going to do is I'm going to look at trend killer or trend killer events. So my hypothesis is when you do see a trend killer event, and if you don't know what that is, I'll explain it when we get to that part of the video. But when you see a trend killer event, sell immediately. Sell immediately because the probabilities are against you. The share price will rebound. So I want to test that. I want to continue testing that, and I do want to find those occasions when that philosophy would fail. And I think I do have a few instances of that. And I do think I have about 15 charts to look at, 10 to 15, of trend killer events that have happened recently on the ASX. Okay, so let's start off with the XJO, or the Aussie indices. And a pretty good week on the XJO. In fact, a pretty good week for the Aussie market. Pretty good week for international indices, international markets, which is a complete opposite to what happened on Wall Street. In fact, they had a pretty negative week, and you don't usually see this connection when we have a really good week and the Americans have a bad week. So what's happening there? I don't know. Now, this might mean that we have a bad week, they have a good week, or maybe we have a good week again, they have a bad week, or maybe we have a bad week, they have a good week. Who knows what's going to happen? And the whole reason I'm saying that is because there's a lot of uncertainty in the markets right now, continued uncertainty. We just don't know what's going to happen in the next week, the next 2 weeks, the next month, could even say the next 3.5 years. We just don't know what's going to happen. And that uncertainty could lead us to go lower, particularly if we do go into recession or a deep recession, possibly even depression, we will see the markets drop significantly from here. And I do think that is a risk, but it doesn't mean it is going to happen. So a lot of uncertainty right now, and that means we just don't know which way the market's going to go from here. But we have seen the ASX drop, or the XJO drop a fair bit since its recent highs, which was back in February. Now, what I've always included this for the XJO, these two orange upward sloping lines. That is the upward trading channel the XJO has been within for the last 15 years. Only briefly has the XJO fallen above or gone above or below that line, that trading channel. That was during the COVID-19 financial panic for a brief period in 2021, August. And also recently, we did see the XJO just get above it for about 2 months. Well, maybe not that long. And I was thinking at that point, there is definitely an argument that the ASX is a little bit overvalued and it's primed for a pullback, and we have seen that pullback. And someone did ask me, it could have been a question, or maybe I just stated it in a video, that I would become way more interested in the XJO if I saw it fall to about 7,100, which would be near the bottom of the trading channel. And last week, or 2 weeks ago, it fell to 7,200. And that was a good time to buy because we saw a tremendous bounce. That was on that Monday, that really volatile Monday, when I think we were down 6% on open, and then we rallied during the day. And that was actually an okay week. We're only down, or the XJO was only down 0.19%. It seemed like it was down a lot, but it was down to not much because it was so volatile. And then we had the pretty good week. And during that week, last week or 2 weeks ago, the XJO did fall below the 200-week moving average. So again, that was a possible buy signal. Because if you look at history, whenever the XJO, since about 2012, 2013, whenever the XJO falls below the 200-week moving average, has been a good time to be bullish. Yes, we saw that in late 2015, early 2016, during the bottom of the iron ore cycle, maybe even the mining cycle. We saw BHP get down a share price of $14. That's why we saw a lot of weakness in our markets back then. That was a time to be buying, particularly those sort of mining companies. We also saw it during late 2018, during the last time Trump was in administration, and he was heavy on tariffs, possible tariff wars, also the spectra, or the threat of rising interest rates was also a bit of I don't know how to say it. It also led to a bit of weakness in the markets, that threat of rising interest rates, and also during COVID-19, of course, that panic. We saw the market drop significantly. Also, we saw the XJO fall below the 200-week moving average in June 2022 and October 2022. And that was a period where we saw rising interest rates, a bit of weakness in the market. And we also saw, during a brief period in October 2023, don't know what happened then, but it did fall briefly below the 200-week moving average. And then again, 2 weeks ago. So is this buying opportunity? Or has it passed? Has it passed because now we are above that particular moving average? And it wouldn't be surprising to see us rally from here. Wouldn't be surprising to see us see more downside and fall below the 200-week moving average. Now, it all depends on whether we do see significant weakness in the economies. And if we do see that, I would expect significant more downside to come from here. Even though some experts say it's a very small chance, other experts are saying it's a much greater chance. So no one really knows. That's why it's all based off probability. Okay, so that's the XJO. In fact, if you have a look at this weekly chart, I could classify the XJO as a high quality index. It has the characteristics of a high quality stock. So why not? Yeah, XJO is a high quality index, which would mean any sort of ETF, maybe the STW, which I'm pretty sure is the ASX 200 ETF. This is like a high quality stock. Yeah, so if you're just interested in ETFs, wait there, we've got to go back to the XJO now. If you're just interested in ETFs, yeah, any sort of ASX 200 ETF, yeah, thumbs up for me. From me, anyway. I would still try to time buying when it does fall below the 200-week moving average because that is better value. But yeah, maybe you could just dollar cost average. Now onto index that I don't think I would classify as high quality. That is the XSO. In fact, I'd probably be the complete opposite. In fact, I am thinking maybe I shouldn't even look at the XSO anymore. And there's a reason behind that, is because there is a rotation of the better companies out of the XSO and rotation into the XSO of lower quality companies, particularly bigger companies. And I don't like that feature of the XSO. I do like investing in small cap companies, but the whole point of investing in small cap companies is you want to invest in the better quality small cap companies who are growing and expanding. And those companies, when they are in the small caps, they will eventually graduate, hopefully, into or out of the small cap index into the bigger indexes, the big cap indexes. And that is the sort of companies you want to invest in. And those companies will get taken out of the small cap index. And if you have a look at the long-term history of the small caps, it's not a sort of index that is or has the characteristics of a high quality index or company, whatever. In fact, the index has not gone past the highs it saw back in 2007, and that is not what you want. So let's move on from the XSO. It's not a high quality index. However, it did have a pretty good week, up, what was it, 2.3%, but the other indices also had a pretty good week. Onto the XTL, which is the ASX 20. This one also has the characteristics of a high quality company, high quality index. We'll say that. High quality index. You buy when it gets below the 200-week moving average, and you do fairly well. The reason I do like the ASX 20 or even the ASX 200, these type of indexes, is because any company that is taken out of this index is taken out because they're crap or bad, or they're performing bad, or the valuation is decreasing, and what is put in place of those companies is better companies, well, hopefully better companies. So over time, there should be a transition to higher qualities within these indexes. Now, some of these higher qualities that get put into the ASX 20, over time they become more mature and the growth slows, but that could take a while. So I would definitely classify the ASX 20 as higher quality. There's definitely some companies in this that I would not invest in, particularly the banks, unless they're cheap, and mining companies. But there's also quite a few really good high quality companies in the ASX 20. REA Group, CSL, WiseTech, sometimes Promedicus is in it. Is WiseTech still in it? In fact, we can have a look. If we go to Market Index and just have a look at the top companies by market cap. So, yeah, CSL, yeah, I would argue Wesfarmers is definitely quasi high quality. Macquarie Group, same thing. Guzman Group, same thing. Aristocrat, high quality. Sigma, yeah. Chemist Warehouse, I'll probably classify as high quality. RA Group, yep. WiseTech is not. It's actually number 22. And Xero's at 24. So these are sort of companies I think in the future will definitely be in the ASX 20 on a permanent basis, but not just yet. And Promedicus at 26. That is another company that I think in the future will be permanently in the ASX 20. And ResMed at 28, another company that I think is high quality and will be permanently in the ASX 20. So the more of these companies get put into the ASX 20, the better quality that index is. So I am bullish on the ASX 20, funny enough, even though I don't like some companies in it. And you can sort of set out just with the chart. It's a nice looking chart. And again, is there any ETFs that are just focused on the ASX 20? I actually have no idea. But if there is, yeah, just find that ETF if it falls below the 200 moving average. What about the tech? Now, the XTX hasn't been in existence for very long. And when I say very long, I'm talking about 5 years. So just before the COVID-19 panic, that's when it got created. So we're talking about February 2020, so about 5 years. And so we don't have a very long 200-week moving average, but I could envisage this one being a high-quality index. In fact, it did bounce right off the 200-week moving average not that long ago, so 2 weeks ago. Look, beautiful bounce off it. And also, just like the other indices, another good week for this one, up 1.21%, so not quite as good as some of the other indices. So the XTL was up 2.5%. XGO and XSO also both up over 2%. So a little bit of weakness in the tech, and I think that's probably because of the NASDAQ. We'll have a look at the NASDAQ in a second. What about the bank? XBK. Now, if you do have a look at this one, now this one hasn't been around long either. I didn't realize this one. So this one hasn't been around long since April 2019. I probably would not be a fan of this one because it has 7 companies in it. They're all banks, and I would probably consider the banks to be low quality. Yeah, that's just my opinion. I would consider the banks to be low quality. If I had to choose any of the banks, I'd choose CBA, but CBA is ridiculously overvalued right now. So I'd probably have less interest in the banks personally, or any sort of index that is just bank related at this point in time. Now, if it drops a lot, I'll become interested if it drops a lot. Okay, let's move on. Shall we have a look at the New Zealand Stock Exchange? I think this is the New Zealand 50. Oh, look at that. Oh, this has been around since 2004, 2003. This one actually looks pretty good. This is actually a really good index. This is a really good index. NZX 50 index. This looks really good. I'm surprised by this one. Yeah, that's stunning. Sorry, New Zealand, I will never make fun of you again. That's a pretty stunning index. Okay, let's move on to the American indices. And by the way, New Zealand had a good week. Yeah, up. Oh, only up 0.83%. So slightly disappointing compared to Australia. But, you know, I suppose that's how all New Zealanders think about Australia. We're slightly more disappointing than our neighbours, our big brother. I'm making fun of you if you're a Kiwi. Anyway, onto the American indices, starting off with the NASDAQ. According to this, NASDAQ was flat on Thursday's session, no trading on Friday. But for the week, the NASDAQ was down 2.31%. So again, a bit of disconnect from the international markets and the American markets, much weaker, down 2.3%. I'm going to, actually, in fact, what I'll do is, I was going to have a look at all the weekly charts for Dow Jones, NASDAQ, and the Russell 2000, then have a look at the daily chart, which they are looking weak, but I'll just focus on the indices for first. So NASDAQ had a pretty bad week, but again, high quality index, and this is the telltale sign of a high quality index. And if you buy any sort of ETF, I think the ETF in Australia is the NDQ. So I actually am looking at the NDQ index, but I'm pretty sure the NDQ is the NASDAQ index for Australia. NDQ Beta NASDAQ ETF. So if you just bought that ETF, when it went below the 200-week moving average, you probably would do really good. It got very close last week or 2 weeks ago. We can see it falling below the 200-week moving average back in October and November 2022. And that is a period I was buying a lot of American companies. I didn't really focus on the relationship with those companies or the index to 200-week moving average. It was just, I don't know, I was seeing these companies much cheaper, and I thought, oh, what a great time to buy these high-quality companies. And if you go back through time, the NASDAQ bounced beautifully off the 200-week moving average during COVID-19. I think that was just coincidence, but look at that bounce right off it. It sort of got very close during that week period in late 2018. Not much weakness in 2015 and 16, unlike the XGO, because less mining, less reliance on mining companies for the NASDAQ. So I don't really see that weakness then. A little bit of weakness, but not much. And yeah, the NASDAQ has been consistently above the 200-week moving average. It went below it for a long period of time during the GFC. So that was a time to buy. And during the tech bubble, of course, the tech bubble. But look what happened before that. Look at that massive rise in the NASDAQ. It was just so overinflated that it was going to drop like a rock. And that is a problem when you get a period of time when it's overvalued. There's a chance that when it becomes undervalued, when it drops, it's going to become significantly undervalued. And that's exactly what happened to the NASDAQ back in the early 2000s. So definitely a high quality index. I think there's no debate about that. Unless you think the American empire is going to collapse. I think it's a possibility. Not a likelihood, but it's a possibility. Dow Jones, I'd probably consider this to be high quality as well. I'm skip past the S&P 500. But yeah, Dow Jones, just by looking at, by the way, in the week, Dow Jones down, what was it? 2.66%, so another week. Oh, by the way, I forgot to look at the NASDAQ daily chart. These are looking weak. So we had that massive bounce on Wednesday, the 9th of April. and that bounce has not continued. In fact, we're starting to see the Nasdaq and the other indices roll over, which is not a good sign. So the American indices are looking really weak, particularly compared to the Australian indices, and the same thing with the Dow Jones. Look at that; it's starting to really roll over. So I wouldn't be surprised to see new lows being reached within the next few weeks. Now back to the Dow Jones weekly chart. Yeah, it has the hallmarks of a high quality company or high quality index. Keep saying company. Very similar to the Nasdaq, which is interesting. And funny enough, the Dow Jones bounced off the 200-week moving average 2 weeks ago. There it is, bounce. Fell briefly below back in October 2022, and for about 3 or 4 weeks during COVID-19. But Dow Jones Industrial Average, a nice high quality index. Can you buy Dow Jones Industrial ETFs? I don't know. Just showing you my lack of knowledge when it comes to ETFs on the ASX. Okay, what about the Russell 2000, which is, what is it, the smallest 2,000 companies in the Russell 3000? So sort of like a small cap proxy, maybe similar to the XSO, that some companies will move up from the Russell 2000 into the Russell 3000, so they get taken out of the Russell 2000. So maybe the same dilemma that the XSO has. So let's have a look at the Russell 2000. Better than the XSO, I can definitely say that. And if you do have a chance to buy a Russell 2000 index or ETF, yes, I don't mind this one either. And by the way, the Russell 2000 didn't have that bad of a week. In fact, it was up 1.1% for the week. So a little bit of strength in small caps. So maybe that is why the international Australian markets had a good week, because it's the down period in the Americans, the Wall Street, was just the bigger companies, the tech companies maybe? Yeah, maybe. I don't know. It's very interesting that the Russell 2000 had a good week, relatively speaking. Anyway, the futures are not yet open. So just below those indexes, I'll have the futures. Now on to international indices. I'll take a small break. I'm just going to pause for like 5 seconds. Okay, taking a break. Now onto the international indices. And let's start off with the Nikkei. What I call, not bad. Nikkei looks pretty good. It's been looking good since 2013 after a period looked pretty weak. And that's after a long period of looking weak since those highs back in 1989, 1990. Definitely Japan was not the place to be investing your money during that, was it 20-year period? But since the shift in sentiment and the trend back in 2012, Japan has been a great place to invest. And whenever the Nikkei falls below the 200-week moving average, just like some of those American indices, great time to buy, or just like the Australian indices, apart from the XSO. And if you have a look what happened 2 weeks ago, it fell below it briefly, and then we've seen a nice little rally. In fact, the Japan 225 index was up 3.41% in the last week. So again, a bit of disconnection between Japan and the United States. Can the same thing be said true for Hang Seng? Yes. Hang Seng up 2.3% in the past week. Funny enough, this one looks all over the place. This one, you can't really rely on buying when it gets below the 200-week moving average. Yeah, I probably would say that with confidence. It was in a pretty long downtrend for about 3 years. Looks like that downtrend has come to an end. So maybe now is a good time to buy buying some companies listed on the Hang Seng. So yeah, because we have seen the index move above the 200-week moving average. DAX, a couple of good weeks. Well, relatively speaking. In fact, the DAX was up 4.08% for the week. So this was a really good bounce in the DAX. Look at that bounce. Look at that V-shaped recovery. Will that continue? And if we look at the 200-week moving average for the DAX, yeah, this is another high quality index. Buy when it gets below the 200-week moving average, if we can. Do we have a DAX ETF on the ASX? DAX ETF. We have one on NASDAQ, Global X DAX Germany ETF. And I don't see it on that could be a negative thing. Maybe we should have a DAX ETF on the ASX. Maybe there is, I'm just missing it. Anyway, so pretty good week for the DAX, and I assume we had a pretty good week for the FTSE as well. Yes, in fact, this could be the best performing index, up 3.91% for the week. And you can also see a really good rally in the FTSE. Look at that rally. Beautiful rally for the FTSE. And if we go back to the weekly chart, yeah, I don't think this is as strong of an index as maybe the DAX and some of the American indexes. That could be because the FTSE is more of financial stocks, oil companies, that sort of thing. I could be completely wrong. I haven't really studied what's in the FTSE, but I'm just assuming that that is true. Sort of similar to the Canadian Stock Exchange, the TSX. This would be fairly similar, in my opinion, to the ASX or the XGO, full of financial and mining companies. And again, nothing wrong with this index. I don't mind this index at all either. So really the lowest quality index looks like the XSO. I'd probably say the highest quality index is the NASDAQ or maybe the Dow Jones or possibly even the DAX. Okay, that's it when it comes to indexes. Now on to commodities, and we'll start off with gold. We'll stick with the weekly chart. Gold is down in the last day, 0.4%. We've had a couple of really good weeks. Now, the gold price is getting well above the 200-week moving average. Now, that could be a sign of concern because when you do see a bit of a displacement of the price of anything with the moving average, there will be a greater chance of mean reversion. So, greater chance that we will see the price pull back. So, last time we saw this was probably back in August 2020. We can see gold went on a really good run, was well above the 200-week moving average. We did see gold pull back, but then we see gold go into a sideways movement for about 3 years. So, in a consolidation period for about 3 years. And that could happen now. This could be the top right now. It could be. And we might see gold go sideways for another 3 years. It could happen. We see this sort of thing all the time. So I'm not sure if I would be buying lots of gold companies right now just because of that. We also saw a good comment from whoever was, Simon maybe, who mentioned that he believes that the gold trade is crowded. And I definitely can see that argument, but also alongside that, that I think we are seeing a bit of a toppish behavior from gold right now. Maybe we'll wait and see. It would be interesting to see if we do see this at the top and then golds go sideways for a while. But again, if we do see the economies move into recession, depression, you probably see gold go on a really good rally. In saying that, yes, look what happened in the GFC. Actually, no, that's not absolutely true. There was a little bit of weakness in gold during the GFC, not massive, but at that point, gold was in a nice bear market. Beautiful bear market. Anyway, just be careful that, there are possible signs that gold is getting a bit toppish. Can we say the same things about silver? Not so. An okay week for silver, up 1.75%. I think there's a chance you might see gold go sideways for a period of time and then silver try to catch up. I could definitely see that playing out. There should not be much of a disconnection between gold and silver, but there is. In fact, silver is still well below the highs it saw back in 2011, and gold is well above those highs. Well above those highs. In fact, it's almost double those highs. But silver's not quite to that level just yet. So I think there could be more upside for silver. What about copper? Dr. Copper. So just because it is Dr. Copper, and if we do see significant weakness in economies, I would definitely see copper falling from here. But it had a good week, up 4.78%, so no problem with that. The weekly chart, We did see copper drop like a rock, and there were concerns about the economy. This could be just a bit of a bounce, I wouldn't call it a dead cat bounce, but this just could be a bounce because we did see copper drop a fair bit. I'm not that bearish or bullish when it comes to copper right now. I think this is one where I just want to see what happens. Just want to see what happens with copper over the next few weeks. What else can we look at here? Iron ore. Iron ore for the week, up 0.77%. But look at this chart. It's just going up and down or up and above. No, that's the same thing. Up, above and below, yeah, up and down, or up, above and below, yeah, above and below the 200-week moving average since 2021. After that, remember that really good period for iron ore back in 2020, 2021, when it went to well above $200. That was never going to last, and then it dropped like a rock, just like it should. We see this all the time. And just look where the iron ore price was compared to the 200-week moving average. And yeah, it was not going to last. And then since then, we've just seen a fair bit of volatility. Now, you could argue that volatility is starting to lessen and lessen. So the highs keep getting lower, and the lows, well, there's not much, there's not much, they're not getting higher or not getting lower. Anyway, so it does look like there's a little bit less volatility in iron ore. There is that threat in 2 years' time when that Guinea iron ore mine does open up, that there will be a flood of iron ore supply onto the market, and that might lead to weakness in iron ore prices. Anyway, so at this point in time, you don't think you can be bullish when it comes to iron ore just by looking at this chart. And I don't think you can be bearish either. And if you have a look at the daily chart, I don't think you can be either of that. You could maybe say around $90 is a good time to buy. So between 80 and 90 is a good time to buy, and that's been true since 2019. In fact, iron ore hasn't been below 80, and if it does go below 80, that is a time to buy. And you can see back in 2016 was a weakness in iron ore, the bottom of the iron ore cycle. That was in late 2015, early 2016. Iron ore was at $40 and BHP was at $14. Uranium. Now, this one's a little bit different. So uranium is in a downtrend. Now, it has fallen below the 200-week moving average. Doesn't mean it's a buy. I think that could mean it's getting more interesting. Now, that's the weekly chart. If you look at the daily chart, no, not much interest in iron ore, uranium just yet. It's still in a downtrend. So, yeah, not much interest in uranium just now. But it has fallen a fair bit, has fallen below the 200-week moving average, is now the time to become interested. What about oil? No interest in oil. You can just see why by looking at this long-term chart. No interest in oil. In fact, when oil got above the price it is now, 63.68, was back in 2005, 20 years ago. That is a time that oil first reached the prices it is right now. So that means nothing much has happened in 20 years. Doesn't mean oil can't go through another boom period. That would not be good for the economies right now. So at this point in time, oil, I just have no interest in oil. No interest. I would become interested if we sort of fall a fair bit, sort of like we saw back in 2020. Remember, oil got to zero or something. That was a time to be interested. In fact, I did own Woodside for a period in that time, and I do know, I keep getting messages that Woodside is not an oil company, but it still trades like an oil company. So anyway, someone mentioned it recently. And yeah, I can't find it. Anyway, so no interest in oil. Gas is looking, even gas. Look at gas. Just done nothing. Again, maybe that's why Woodside does nothing. Yeah, gas was looking interesting for a while. Now it's sort of pulled back the last month or so. Lithium, no interest in lithium at this point in time. Coal, no interest in coal at this point in time. In fact, coal keeps going down, and I'd assume, without even looking at it, coal companies on the ASX are going down as well. Tin had a nice 1 week bounce and has gone back down. So no interest in tin at this point. Nickel, I very rarely have interest in nickel anymore after I learned a little bit more about what's happening in the nickel market. And palladium, looks like it's moving sideways. It's in a consolidation period. So maybe now there is a low in palladium. And finally, cocoa. Any interest in cocoa? I want to see cocoa drop significantly, but who knows? Okay, so that's all I've got to do when it comes to commodities. Now on to Bitcoin and Ethereum, and I'll stay on the weekly chart. Okay, so using this 200-week philosophy when it comes to stocks and indexes and commodities, can we do the same thing with crypto, Bitcoin and Ethereum? By the way, Bitcoin is well above the 200-week moving average. So you could say because it's well above it, when it got to $100,000, that was the time to sell. And you can see that has happened in the past. Whenever it gets well above the 200-week moving average, it drops. And then on occasion, it gets below the 200-week moving average. Funny enough, through history, and we start the 200-week moving average back in 2015, so about 10 years ago. And I'll be honest with you, whenever Bitcoin does fall below the 200-week moving average, has been a great time to buy. So I've done about late 2018 at about $3,000, $4,000. Again, during COVID-19 when it fell to like $5,000. And then again in 2022 when it fell to $16,000. So between 24 and 16. And I actually did buy some Bitcoin. I bought Bitcoin at $20,000. So that would have been about here in early 23. So I was not using this philosophy when I bought Bitcoin. I just thought when it got it back above 20,000 was a good time to buy, and it's worked out well for me so far. And since then, it's been above the 200-week moving average. So maybe the 200-week moving average strategy works really well for Bitcoin as well. What about Ethereum? And Ethereum, we have the 200-week moving average going back to 2019. A lot of volatility in Ethereum. And I don't know about this one. Not as confident with this one as I am with Bitcoin. But if you are confident, Ethereum is well below the 200-week moving average. So maybe now is a time to think about buying this particular crypto, if that's your thing. Okay, now on to bonds. And we saw that really, in fact, I'm going to go to the daily chart, this one. So we saw that really big rally in bonds. It sort of makes sense. I'm thinking about it more and more. So there was that talk about Japan offloading bonds, wanting to sell bonds. There was also the theory that Canada Prime Minister, they were offloading bonds. Also, China was offloading bonds. So if a lot of people are offloading bonds, bond prices by definition need to go down. So you have more supply of bonds. If the demand doesn't change, prices of bonds must go down by definition, which means bond yields must go up, because don't forget, bond prices and bond yields are inversely related. And it sort of makes sense. So if you want to offload bonds and prices going down, I'm not sure which one will go first. If you want to offload bonds, you might have to entice them with high yields, sort of like that, because I don't know how it works exactly, but it all makes sense in the long run. If bond prices are going down because of increasing supply, bond yields must go up. And we saw a massive rally in bond yields. And if everything is correct, this is why Trump relented and he paused tariffs, because of what he saw in the bond market. Anyway, so I'm not sure if that's rumors or if that's true, but it does make sense. Anyway, so if you go back to the weekly chart, by the way, I heard something else that because China has so much American debt, they could destroy America like that, just by flooding the market with bonds. And if they flood the market with bonds, bond prices drop like a rock. Bond yields, American bond yields, just go through the roof. So this was, someone was saying that China could do this. And I was like, ooh, gee, it makes sense, but would they do it? I'm not sure. If you go back to the weekly chart, so don't forget, so there was a multi-decade bond bull market. So you might be saying, what? But look at this. The government bond yields were going down from like 1980s all the way through to the 2020s. That's not a bam bull market. And don't forget again, bond yields are inversely related to bond prices, which means during that period, bond prices were going up. So they were in uptrend. And funny enough, all you had to do during that period was buy and sell based off where the bond yields or bond prices were compared to the 200-week moving average. You probably did fairly well up until 2022 when the trend changed. I don't think it's going to change for too long, but who knows? Okay, I wonder how long the Australian 10-year bond yield goes for. Let's have a look. Oh, early 1980s. And just like the 30-year bond yields, American bond yields, again, you can see a multi-decade long bull market until 2022. In fact, the TLT ETF, well, that won't go back that far because ETFs have been around that long. But look at this. TLT started 2002, and look at the rise in the TLT. So this is should be inversely related to bond yields. And it reached a peak in 2020 and it's been dropping ever since because bond yields have been going up. So now could be the time to be buying the TLT ETF. Aussie dollar gone back up to 63 cents. Funny enough, just by looking at the I don't think this would play out the 200-week moving average, or it might. You can see there was a nice little trend in Australian dollar from 2003 to the 2013, so a 10-year bull market in Australian dollar. And then since then, we've been in the bear market. So maybe that sort of strategy would work even for currency. Don't know. Okay, and I don't really care. The only thing I care about is I want to see Australian dollar get up to like $5 American. That'd be great. I could have the cheapest holiday ever. Whew. Of course, that will never happen. Okay, now on to the individual stocks. Looking at trend killers, stunning trend killers. And what I'm going to do is have a look at some recent trend killer events and just see what has happened after those trend killer events. I think it's very important just to keep a track on the share price movement of these companies. And I do think this could be a really good strategy, particularly, well, if you want to go short, but particularly for the reverse. Well, not the reverse, but if you see a share price of a company in a downtrend and they release something really positive, share price pops up. And I have started to play this strategy with the APA Group, NIB Holdings. I think those are two big ones. And so far, it has gone well. So and I started looking at this particular trend killer from the viewpoint of it destroying an uptrend, because I wanted to see if that was a good reason, a good time to get out of a trade. And it so far has worked out pretty well. So the first one, and I'm going to go back to daily charts because the trend killer is a one-day event. It's not a weekly event. It's a one-day event. So what I'm also going to do is I'm going to have a look at my usual one-day EMA moving averages, which is a 25-hour-a-day moving average. So I was trading Nuix for a while, a beautiful long-term uptrend. You can see a beautiful uptrend until the 14th of November 2024. Share price of Nuix dropped 22% in one day, and that is a trend killer event. But it didn't play out exactly as I thought it might. We saw the share price go sideways for a while, and I think the reason why the share price didn't collapse after that is because the share price, when there was that trend killer event, it didn't drop below the moving averages because the share price was in a significant uptrend before that. It rallied a lot. So I think a lot of people saw the share price drop 22% and went, oh, I wanted to buy some Nuix shares, but I got a little bit too expensive. It ran too high. Now is the time to buy. So we saw, in fact, Nuix share price go sideways for about 2 months. Yeah, 2 months. Went sideways for about 2 months. That's a good sign for me. That's a sign that, I think the puff is running out of this uptrend. And then we started to see the share price drop. They released results or something, a trading update on the 28th of January. That was an interesting day because the share price rallied and kept on rallying. But that rally petered out And look what's happened to share price since then. It's just gone down and down and down. So this is a definite trend killer event, in my opinion. That was the time to get out. And I did get out on that day. I was trading it. I got out on that day. Maybe it was the next day. I can't remember. But yeah, this is a really good example of a trend killer event. I got out. I can't remember what I got out. It would have been between 6 and 6.50. Share price now is 2.34. I still remember getting out and thinking, should I? This is actually one of the reasons why I started studying trend killer events, because I was really conflicted when it came to Nuix. I was like, oh, should I get out? Should I not? And I need some validation, yeah, something like that, some word like that, yeah, this is the right thing to do. Yeah, and I think, yeah, it was the right thing to do. Share price is more than halved since then. Now, Appen was not something I was trading. So a lot of interest in Appen. It went on a massive run from August through to February. So a 6-month run. The share price went from like 50 cents up to $3. We're talking about 6-bagger. A lot of interest, a lot of volume. I'm pretty sure day traders were trading the hell out of this one. And then all of a sudden, when they released results in February, share price dropped 33.33% in one day. And for me, if I was trading this company, that was get out, an immediate get out. And you can see it was a negative one-day candlestick, just like Nuix, a solid, almost solid red candlestick. And that is a telltale sign of a trend killer event. And look what's happened since then. You could have got out near the bottom on that day at about between $1.75 and $2, and you still would be feeling really good because the share price has more than halved since then. It's now down to 80 cents. So this looks like, yeah, it really backs up this trend killer event. Get out if you're holding these sort of trades. Okay, it doesn't always work out. So I was trading Perenti. I think this is a pretty solid uptrend. It was looking good. They released results on the 24th of February. Share price dropped 15.94%. And I thought, yep, okay, stick to my rules, get out. So at this point in time, I had introduced this sort of strategy, get out on these sort of events. And sure, the share price hasn't dropped since then. Sort of been a little bit volatile. So I wouldn't say this has been a false signal because we just don't know what's going to happen. But at this point in time, I would say it's a false signal, possibly looking like that. And maybe the reason this could be a false signal is because I definitely could argue that there was some value in Perenti when it did drop on that day. So I could see some value. And maybe that is a distinguishing factor between Nuix, Appen, and Perenti. With Nuix and Appen, I don't think there's an argument there was value when the share price dropped significantly. And I think the share price had run up, not because of valuation or the company was doing really well. It was just based off FOMO and that sort of thing. And I think that's the big difference between the two. Onto Myer, not one I was trading, but the share price was in a nice uptrend between July and December. And then all of a sudden, share price on the 30th of January dropped 23.14%. Not sure why that happened, but look what's happened after that. You can see there was a rally just after that. Nice little rally. Share price went from 80 cents up to $1. And the whole reason there was a rally was because people saw this drop and went, oh, share price has dropped. There's value here. It doesn't always work like that. So share price has dropped. If you sold on that day about 80 or 90 cents, share price has dropped significantly since then. Yeah, so this was definitely a trend killer event that you wanted to get out of. What about Zip? This one is interesting because I was trading this one. I got out before the trend killer event, funny enough. Yep, I did get out before the trend killer event. I think I did. Anyway, I've got back in. And it remains to be seen if that was the right move. We'll see in the next few weeks. So Zip's trend killer event was the 30th of January after a really nice uptrend. Share price on that day dropped 25.38%. And we saw another rally just after that. So again, I think this was just people saw share price drop and going, oh, there's value here. And then the share price just collapsed. It went from $2.75 down to $1.10 in a fairly quick period of time. And again, I think there is problems here when it comes to valuation. I doubt there could be an argument that that Zip is good value at these levels. But they did release a pretty positive update. Share price popped up on that day, on Wednesday, up 16.22%. And I'm wondering if this is a trend killer event in the opposite direction. I'm wondering if the share price is now going to rally. Now, I do think, actually, I'll go in this direction. I'm not confident, and that's why the trade I did make with Zip was fairly small. I'm not confident this is a trend killer event in the opposite direction, but I wouldn't be surprised. So if I see more positive reaction in the share price, I might add to that position. But this is sort of what I'm looking for. Share price of a company in a downtrend, the company releases something positive, and the share price bounces. Share price bounces. But we have already seen a pretty big bounce before that. So I could see this going in numerous directions, and that could be an argument that I should not have taken a trade, just because I can see it playing out completely different to what I'm thinking. Okay, so definitely share price did drop a fair bit from that initial trend killer event on the 30th of January. Ansell, this was another one I was trading. In fact, I still got my orange line. Bought this one, geez, it would have been March or April last year. Yep, so just over a year ago. And it was beautiful. They released really good results on the 10th of February. So this is not a trend killer event. It was a continuation of the trend. Wouldn't call it sort of a breakout either. Share price did increase 8% on their results. But then you can see a lot of weakness after that. And that tells me there was not much strength to those results, or the reaction to the results. Because the share price just kept on dropping. Now, I think another reason why the share price might have been dropping was because of tariffs, the fear of tariffs. And I believe that's why the share price dropped significantly on the 3rd of April, because of tariffs. And we can just see a lot of volatility since then. And I got out on that day. Yeah, that was a get out of this, because I just don't know which way the share price is going to go. And we're seeing a lot of volatility since then. So this is another one I'm going to keep on tracking just to see what happens. Was that one day trend killer event? Was that no reaction for the market? That's a definite possibility. At this point in time, I would say no. Now on to a trend killer event that failed. This was a complete opposite. In fact, we saw this with Ramelius not that long ago. So this was on the 11th of March. Share price down 17% on that day. Share price then dropped another 8.7% on the next day, the 12th of March. Share price hit a support level, and I was thinking at that point, ooh, this could be a nice time to buy some Ramelius shares. Then I decided not to, and look what happened after that. Look at that rally in the share price. Not only that, look at the volume. Look at that massive volume coming through. So that could be a sign, that massive volume could be a sign that a lot of institutions, fund managers saw some value in Ramelius when the share price got down to $2.10. So this is the occasion where this particular trend killer fizzled out and was sort of a bust. Thankfully, I was not trading Ramelius at that point in time. In fact, I was more likely to be buying after that than selling. Oh, HMC, which is one? Oh, HMC Capital. Oh, yeah, this one is interesting. So there's a lot of interest in this particular fund manager property. I think it's something. What would you call HMC? Asset manager, maybe asset manager. Engages in the business of funds management through ownership and management of real estate focused funds. So it's sort of like a funds asset manager. A lot of interest in this company. You can see the share price rallying significantly between October and December. There was a really interesting one-day candlestick on the 27th of November. I reckon that could be a sign that the trend was about to change. I have to do a little bit more investigation into it. But for some reason, that is triggering something in my memory. And then we saw the share price absolutely dive over a 2-day period. So 13th and 16th of December. And on the 16th of December, share price dropped 13.7% on pretty big volume. So it seemed like that could be a trend killer. I don't remember what happened. And it seems like that was a trend killer. They did release results on the 18th of February. Market liked it. Share price up 9.9%. But look what's happened to share price after that. So it seems like we did see a bit of a trend killer event in middle of December, and the reaction of the market when they released results on the 18th of February sort of confirmed that that could have been a trend killer event. Share price, I think it's half. Yeah, more than half since then. Wow. Tuas, this is another one I was trading. This was an interesting one because it's not a true trend killer event. So for me, the true trend killer event is when the share price opens lower and continues to go down. For Tuas, the share price actually opened higher and then dropped during the day. But I've included in the trend killer list because it looks like this has led to the end of the uptrend for Tuas. I just need a little bit more evidence, but I did get out on the day, and I think that was a good move for Tuas. Okay, Guzman Y Gomez. Is this another example of a trend killer? I think so. A lot of interest in this company. They released the results. Share price dropped 14% on the day, dropped another 7% the next day, and the share price has continued to drop. So this is confirming that these trend killer events can lead to a shift in sentiment and a shift in trend. And I think what I might discover in the long run, this is really going to hold true for overvalued companies. And I think Guzman Y Gomez was overvalued. When it comes to not overvalued companies like Perenti, I think maybe it doesn't hold true. Maybe those are instances of it being an opportunity to buy those companies at better value. Okay, Adairs. Okay, Adairs was interesting. This was interesting because what happened here? Because I bought Adairs on a little bit of a dip. I thought there's an overreaction from the market. I can't remember what happened. I think it was, in the middle of January. And then I sold fairly quickly. And then the company released the results. And we saw 2 negative days in a row, down 7% and 11.6%. And that was a sort of a trend killer event over a 2-day period. And that has led to a shift in trend. And the share price has continued to fall. So kind of have to continue monitoring this one. I don't know if you could call Adairs overvalued. In fact, I would say there's an argument it's quite cheap. P/E ratio 11.4, dividend yield 6.3. So it's going to be really interesting to see which way this turns. But I was not trading Adairs when they had the trend killer event. But yeah, interesting to see what happens moving forward for Adairs. And finally, NWR Holdings. Someone did mention in my comment that they do see value with NRW Holdings, and I definitely see their argument. But this was a trend killer event on the 13th of January. I try to remember what it was. What was it? In fact, we can see 13th of January. NWH. Oh, I have to log in. NRW Holdings, 13th of January. What was it? I'm going to kick myself when I read it. Oh, Chief Financial Officer resignation. That's right. And that's why I don't remember it, because I was trading the company at the time, and I saw the share price drop, and I was like, why are you selling on this news? It doesn't really mean anything. He could be resigning for a number of reasons, but the market thought differently, and I just sold. I just went, yep, it's a what do you call it? This was actually one of the first times I actually used a trend killer event. When the share price dropped, I'm going to get out. And that was a good call in this one. The share price has continued to drop. Maybe they released results. Maybe the share price dropped after that. And the share price has plunged. So I sold about 350. Share price has gone down maybe, what's that? It's gone down $1.03 over 350. So it's gone down 30%, just under 30% since then. But this could be valuation. This could be good value. Look at long-term charts. Put that in. Share price is below the 200-week moving average, and historically, maybe not. It's a mining services company. But if you do look at the P/E ratio and the dividend yield, it does look attractive at this level. So maybe there is support for this company at these prices. But you could have said that when the share price was like 330, 340, and it hasn't really held true. So that was another good little or no, we have to look at the daily chart. There was another good trend killer event that has actually played out. But it might have not played out. When I did sell, I was concerned that the share price was going to rally because I thought, why would you sell on that news unless there was concerns that he was resigning because something nefarious happening with the company? And finally, Aroa Biosurgery. Yeah, this one was a good one. So I was actually thinking of trading this one, getting in. Share price had moved into an uptrend, looking really good. And then the company released something negative on 29th of January. Let's have a look at what they released. 29th of January. Why not? I did with NWH or NWR, what is it called? 29th of January. Oh, they released their Appendix 4C. Yes. And this is another reason why I go through Appendix 4Cs and 5Bs, because this sort of thing can happen. Share price dropped 24% on that day. And I'd say some people that day and the next day went, oh, there's some really good value with Aroa Biosurgery. It's dropped. It's much lower prices now than it was the previous day. And I'm going to buy. So they bought we'll say 62 cents. And the share price has dropped 33% since then. And it's in a downtrend right now. Maybe, though, there's some value in this company at these prices. Maybe. Okay, that's all I've got for this video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.